So this LBO quick analysis is really a quick analysis. I wouldn't really use it in practice. Actually, it's okay for if you're just looking at a potential buyout opportunity, or maybe you're expecting an interview where they're asking you to pitch a couple opportunities, and you want to know just from a high level what the IRR is. This really just, but more for you guys for instruction purposes, for preparing for the LBO exam. This just kind of lays out in a more structured form what we're doing on the board, so it's good for practice. So basically, this comes in a few parts. One is the assumptions with considerations we're going to go through. It's going to run some multiples. This is the target company that we're looking at buying out. The company has a revenue of $6 million. And then you want to project unlevered free cash flow. And really the heart of the analysis is this IRR analysis right here, where we are figuring out what the exit is, paying down the debt, etc. So it has some use, but we're obviously going to look at a much more robust model after this. Let's just spend the next 20, 30 minutes going through this, if that. So if you look at the top, it gives you some purchase considerations already. So this is a public company. The company is trading at $20 a share, and we're expecting a buyout at a 30% premium. So let's model out what the purchase price would be, right? Step one in any transaction is the purchase price. So let's take the purchase. Let me go edit this, and let's take the purchase price per share, which is of course the stock price times 1 plus the premium. Oops. And at the diluted number of shares, we would multiply and figure out the purchase price. And of course, well, the shares that they gave you were 750, and it says that they're diluted, so we won't go through the need of looking further. But when you multiply, we have a purchase price of $19.5. So just make sure you are building towards that. Let me save this. Yeah, you're okay with that? That came from the given financials. That was given. And you can use the purchase price. So transaction fees were given at 100. So we're going to pull in the purchase price to calculate uses. And what do we do with debt? Is it included in the purchase price? What do you think? Why not? This is, the purchase price is an equity value, so the net debt needs to be considered. If the purchase price is based on enterprise value, that automatically includes the net debt. So refinance debt is short-term debt plus long-term debt minus cash that's been given. And so there's 20.4 in total uses that we will use to calculate sources. So make sure you're getting that. Okay with that? Yeah? Why are you not doing it? Just staring? Yes.
Can I see how you link that?
Yeah, that just came in from C10.
And that was just Vietnam 9.
That was, yes, C8 times C9.
What was C9?
That came from the assumptions. That was short-term debt plus long-term debt minus cash given. Any other questions? Okay. Then the sources, and I just threw in some percentages here and noticed I want to run a 2 variable sensitivity table later. So if I want it to be just 2 variables, I need to make sure that the sources are based on just one variable, right? So the way I did this was I just kind of partitioned the remainder in sevenths. 4/7 for bank debt, 2/7 for high yield. There's a lot of ways to do this, right? You can do multiple of EBITDA, you can do, but the only reason why I didn't hard code everything is so that when I change the equity to 20%, it would, in the same proportions, adjust the top. The only reason why I want that is so that I can actually have a 2 variable data table. A 2 variable data table won't work if there are more than 2 variables. Right? We've done some sensitivity analyses way back in the DCF. So what that means is we'll just multiply the percentages by the total uses to figure out how much debt we need to raise. So 40% times total uses is bank debt, 20% times total uses is high yield, etc. Mezzanine, equity. So I multiplied. Yeah. And I also want to look at the multiples. Any questions on that? So the EBITDA multiple is the debt raised over the 2013 or given EBITDA. So 8160 is approximately 2.7 times EBITDA. That makes sense. 2.5 to 3.5 fits for bank debt. High yield debt is the high yield debt raised divided by, again, 2013 EBITDA. And so on. So about 1.4 times in high yield debt, and I mentioned total debt should be around, okay, this is a little bit above 3.5. This is 4.1, fine. Mezzanine debt, 2040 divided by EBITDA. And equity, less significant, but we can look at what the equity is as a multiple of EBITDA. This is good just to track. A lot of times your model will be based on the multiple of EBITDA, but it's also good to track kind of doability in raising debts. We'll look at that in the full scale model. We'll do our own debt multiples.
What about like the Dodd-Frank Act and like maximum amount of leverage?
What about it?
So isn't there not supposed to be 170% leverage?
For bank debt for public companies, yes, but one of the benefits for taking companies private is you can go after more aggressive types of lending. If you go after third-party private lenders, you can override those caps.
So you can do the traditional 9-10 or you can step up over.
Technically, yes, if you go after aggressive private funding now, but they're still putting pressure on even squeezing that a little bit. Although that being said, I haven't seen a 90-10 deal done in the past few years. So yeah, so caps, there are caps being done on these debts. So 70-30 is traditional. I've seen 75-25, but yeah, that's the maximum I've seen in this market, and that's aggressive. Even that's aggressive.
Also, someone said 9-10 on each of you, and they were very good.
It could be too much.
What were the 80s?
I've never seen anything that aggressive, to be honest. I've never seen 90. I've known that they've been done, but I've never actually seen them firsthand. Even in the better markets, I've seen 85-15. There was a point in like the 90s where that was the first place you'd try to get to. That's when the high yield markets were really active.
And that would have been like all the stars aligned, so
Yeah.
like basically no dash.
All the stars aligning, yeah, and if you're looking at very, very small companies, I mean, kind of anything's possible. You're under the radar of these kind of Dodd-Frank acts and things like that. Yeah.
You mentioned, in this current environment, that anything past 75, 25. And when you say current environment, are you referring to like low interest rates or?
I'm talking about post 2009. Low interest rates, the elimination more or less of the high yield debt markets, the increased scrutiny that banks have to ask for when providing term A loans, the lack of the ability of investment banks to do these types of investments when they used to be able to freely. It's a lot more difficult to do these things. The lack of good deals out there because there's too many private equity funds out there, there's too much money floating around, all that stuff.
So when you model out the, in terms of ability to repay stress, like what's a good, interest coverage ratio?
There's a bunch of ranges, and depending on the ratios, we'll actually do a debt coverage tab. So let's wait for that. I think it's better when we lay it out with the Hines model. The difficult thing about that is every group, every bank, every firm has their own ratios. So I try to, in the LBO book, because there is no place to find the categories of these ratios, I tried to categorize them as best as possible because there's nothing like that out there. To simplify, all right, well, there's debt ratios, debt to equity kind of, like how much debt's on your balance sheet, one category. There's coverage ratios to see how well can cash come in cover interest, which is like EBITDA to interest. And then there's debt ratios, like what you see right here, EBITDA to debt, which would basically imply how many years it would take to pay down your debt. That, from all the research I've done, those are the three major categories. So we'll try to break it down and simplify it. But there's sadly, there's anything in everything. But I'll give you a more specific answer towards the end. It's a good question though. Okay, so just general sources, right? And uses. Now let's look at some purchase multiples. Purchase multiples are beneficial in giving us exit multiples, right? So I'm going to look at the enterprise value, which is the purchase price plus the refinance debt, right? We got to add refinance debt because purchase price is equity value here. This is not the total uses. Don't just assume enterprise value is total uses. Total uses includes fees. We don't want fees in enterprise value. And then we can divide this by the EBITDA and by the EBIT respectively to get multiples. So the purchase price is 6.8 times multiple, EBITDA multiple 7.8 times EBIT multiple. Those will be used to help us calculate returns. Real simple here, just getting Okay. And here are the interest rates on the debts: bank, high yield, mezzanine. And so the real kind of first step in converting assumptions into a transaction to help us determine what the return is, we'd want to build out an unlevered free cash flow analysis. So this is real crude. I just wanted to kind of have something here in a model. So let's just go out and build real simple, not even with depreciation working capital schedules. We'll do a more complex case later, but just so you have a thought process. Let's take our EBIT. We're going to assume that it's growing at 12%. So this is going to be EBIT times 1 plus 12%. I'm assuming real simple. D&A, let's keep it flat for now. And CapEx, let's keep the same. And let's keep changing working capital the same. I just want to focus more on the process. So I mean, the idea is you build out unlevered free cash flow as you would for valuation, anything like that. We'll get more detailed when we do the bigger models. Taxes is of course a percentage of EBIT. So we're going to take EBIT times the tax rate, which is given above at 40%. And the unlevered free cash flow is simply EBIT plus D&A. After CapEx, we're going to assume this working capital is cash coming in change, so you're adding everything. Right, so I mean the point is I didn't want to get hung up on building depreciation schedules and working capital schedules. Let's just kind of get through I want to focus on what the variables are and a high level understanding. Okay, so now we got some things to do here to help with the transaction. One is totaling up the free cash flows. So we're going to add up the cash flows that we've established as being generated. This will go to paying down debt and interest. So the thought process in this box is a little bit different than what I did on the board. It's the same general idea, but there's just different orders of thinking about it. So here we got to calculate total interest expense. So what I'm going to do is I'm going to calculate the individual interest here on the interest rate. So this is going to be 5% times the bank debt, 6% times the high yield, 12% times the mezzanine. So we're looking at 897.6 in interest per year. Right? That's the way I'm looking at that. So just take a second and go through that. Okay. And so the total interest over 5 years is this times 5 times 1 minus the tax rate, right? Interest is tax deductible. Right? So total interest is this times 5 times 1 minus the tax rate. Yeah, okay with that? 897, you're getting 5 years, and it's tax deductible, 1 minus tax rate. And the way this looks at it is well, it takes interest expense, it gives interest expense priority over debt. So it says, how much cash do we generate? We have to pay interest. What's the cash after you pay the interest? It's the same idea. You're just swapping parentheses if you're looking at it as you did on the board. You're just swapping the order. So this says, all right, well, 8,600 of cash is generated. Let's pay down the interest. We have to pay down the interest, otherwise we're defaulting. We assume we have to pay down the interest. Now this is the cash that's left to pay down the debt. So we subtracted. What's the total debt? The total debt at the beginning of the year is the bank debt plus the high yield plus the mezzanine. And so the final debt is the 14,280. This is the debt that we started with minus the leftover cash after we paid interest. Right? This is how much cash that we've used to pay down debt. This is the final debt left over, 8,373. So that final debt is applied to the exit, but we didn't calculate the exit. Let's calculate the exit. We have some equity return statistics where it's asking for the IRR, which is a result, and the EBITDA exit multiple. Let's use the entry multiple conservatively as the exit multiple. So the multiple was 6.8. I'm going to link it instead of hard coding. If you've hard coded, you might round and get something a little bit different. So I'm linking the EBITDA exit multiple in from the entry multiple. And so the exit enterprise value is that multiple times, in parentheses, EBIT plus D&A. EBITDA. That's the exit. Yes. I did 5 years. Times 1 minus tax rate. Yep, that's why it's. So the market value is the enterprise value minus the debt. This is kind of what we get as a return. Guys got that? Any formulas you want to look at? Yes, David.
We don't take on, sorry, we don't like their existing debt. I'm assuming we include that.
Don't, if you don't wipe the debt, you mean if you don't pay it all down?
Right, let's just say we can go to the equity and kept their previous debt on the book.
Okay.
We concluded with
If you keep, you're still raising debt, right? So you're raising debt, you're keeping target debt, bringing the target debt on. So you have new debt plus you have existing debt. Then yeah, then you'd have existing interest. Yeah. Yep. Absolutely. Okay, so for IRR, I'm going to use this Excel formula. We'll do a more robust version of this in the full scale model, where this consists of an entry and an exit, and the entry, the money we're putting in 2013 is what? What is it? Not the purchase price. The equity, which is how much? 6120 as a negative, money in. And the exit is the exit we just calculated, 25339. And for the formula to work, you have to put zeros in between, which represents years. Right? If you don't put zeros, it's going to treat money in, money out as one period. And so we do equals, we'll just do the simple one, IRR for now. You can highlight the whole row, and that gives you the percentage. I probably should have done it. Well, that's right. Equals IRR 32.86%. You have that.
Well, I'm curious actually, if you did this deal 100% equity,
If you did what?
this deal.
100% equity.
100% for, can you see what the IRR would be?
Yeah, we're going to do that right down here in the sensitivity. So, good timing. So, you know, just for form, I mean, you can just, this doesn't go anywhere, but this, you can link in the returns up top. The only reason for that is sometimes, like in your pitch books and stuff, you'd put this whole box in here and want to see what the IRR is based on the considerations. And it's formatted. But so, let's rehash what the key variables are. What are the key variables in an LBO analysis? And you kind of hit on them when asking for inputs this morning, but you kind of went out of order. So the more we do it, the more, you know, you hit the right ones, which is good. The more we'll get it in order. Where do you start? What's the biggest variable in the beginning? Arguably, purchase price, based on the premium or the multiple. What else? Debt raised. Yeah, the sources. Debt raised and interest on that debt. So, you know, as you're kind of looking at potential targets, the first kind of question mark is what the value of the company is, how much can I reasonably pay, how much would the seller be willing to negotiate, and how much funding can I really get, which is depending on due diligence, the assets the business has, cash, debt multiples, things like that. As the transaction proceeds, right, and as you know, you've established negotiation terms with the seller, which takes a while, right? And once you've finalized a purchase price, and once you've pitched this to lenders, and once lenders have started to get the financing ready in order, what's the next set of variables that you'd want to consider? Target financials. Managing cash flow, the timeline. What's your time to exit, right? EBITDA growth, cost cutting, working capital, right? Now this is where as an advisor and an analyst, the modeling stops, right? Once you're beyond the pitch stage, the modeling stops because on the private equity side, now you're converting from a kind of pitch M&A LBO model into an operating model. Now it's about how well are you meeting EBITDA targets. So if you're ever working at a private equity fund and building out models on portfolio companies, you're building operating type models, right? Or kind of, which is like now, all right, well, we're supposed to have this much EBITDA to hit our hurdles. We're supposed to have this much EBITDA to hit our hurdles. So let's make sure we're sitting with the CEO, CFO, make sure we're achieving those hurdles. What's revenue thing with that? That's the operating model stage. That's kind of after the fact, right? So your model, your mentality switches gears. The variables come to, are we achieving our hurdles to hit IRR, to maximize IRR? If we're not, what can we do to do that? So EBITDA growth, CapEx, depreciation, all that stuff. This becomes the variables. What else is a variable? Anything? What else? As we get towards the later stages. Exit multiple. Right? So exit multiple is a variable. Will you find a buyer and what is he willing to pay? So, you know, once as you're managing the business, the thought in the back of your mind is always looking for an exit, right? The deal will not be profitable until you find it some sort of exit. So there's a series of sensitivity analysis that you would do depending on the stage of transaction that you're at, right? More commonly, the purchase price versus the sources and uses of debt. right, is one at the beginning as you're negotiating the transaction. All the way towards the later stage, which is, when will we find a buyer and how much is he willing to pay? And then when so, is it worth selling? So more sophisticated models will be flexible based on exit year and exit multiple. How do you build a model that's flexible based on exit year? And we'll do that with the Heinz model. So we'll look at that. But so in the early stage, it's always based on equity and sources. So the way I'm looking at this now is, all right, we have a 30% purchase premium. What happens if the premium increases? We're right now putting in 30% equity. What happens if the equity increases or decreases? Will our IRR look better or look worse? So I have a template in the bottom for a sensitivity table that's based on these two variables. So the way a two-variable sensitivity table works, if you remember from our DCF, is first in the upper left corner, we have a link in from what we want the table to be populated with. We want the table to be populated with IRR. We want to see how the IRR would vary based on certain conditions. So we're going to link in the IRR into cell B53. To the right of that IRR should be one set of variables, 10, 20, 30, 40, 50. This is going to be varying equity. So we didn't do 100, but we'll do 100 case. And then underneath is 10, 15, 20, 25, 30 varying premium. So what you do is you highlight the whole box, and you can do Alt-DT, Alt Data Table, or you can do, depending on the Excel that you have, data validation. I think everybody has data validation somewhere. Sorry, not data validation. A what-if analysis, data table. And everyone should have this box. And the box asks for two inputs. Row input cell says, all right, well, these variables across the row, 10, 20, 30, 40, 50, where does it go in the model to adjust those variables? And this is where, when I said in the beginning, the model needs to be dependent on that one variable. Because if everything was hard-coded, and this data table changes equity, but that doesn't affect anything else, it's never going to work. So the row input cell is H10. Column input cell asks of the variables up and down the column, the 10, 15, 20, 25, 30, where does it go in the model to affect that? That's the purchase premium. And then you hit OK. And now we see the impact of the percentages over time. Does this make sense, right? So as our premium increases, our IRR is going down. Does that make sense? Why? You're paying more. More debt, more equity, more funds, more cost. As your equity increases, the IRR is going down. Does that make sense? Yeah. Right? If it was 100% equity, you could just override this with 100%, and it goes down a lot, right down to 15%. So, this is just one way of quickly looking at a multitude of sensitivities at once for output and presentation. Question? Yes. Yes.
Do you know why you might get like errors on only a couple of the cells, but the rest would be normal?
Are you getting that now? Oh no, you're not getting that. Maybe you have it divided by 0.
Because it's like in the 10%, it would like give half of the rows numbers and the other like top half would be,
something like, I don't know what would do it in this case. I can't think that quick, but
just a broken table now?
maybe you have faulty assumptions, right? I don't know. It depends on your situation. If it's everywhere, it's a broken table.
Yeah.
If it's just in certain areas, then I'm guessing you're running a scenario that's not a viable scenario. That's my guess without looking at it. I can't, if I do 0% equity, I'm going to get that's my best guess. Any other questions? Okay, so this should help kind of clarify a bit from a high level. We'll do a few more of these examples. I want to ask a lot of interview prep questions that are asked on this, different ways. I'm sure they'll throw you off in the beginning, but it's good to know them. Tomorrow I scheduled Julio's going to come in and do a Harvard case. He's done it before, and it's pretty good. He's doing either a merger case or the one on Bear Stearns. They're both good. It's 3 hours, though, so I hope that works with your schedule. And in lieu of that, so we're going to have a couple of slightly longer sessions. The Thursday after next, I'm not going to have class. There's just scheduling conflicts, and because of the fact that we had an hour, if you remember, we had a 4-hour orientation, and we have a 3-hour class tomorrow. That's going to fill up the need for that class. We might have a couple more. So Thursday, so it's not like we're cutting out material. It's just we're pushing it up the 13th. So I hope you're okay with that. Tomorrow's going to hopefully be interesting in a different perspective. Don't forget the test on Monday, which is on M&A. So this is all we're going to go with LBOs. So there is reading that goes along with this stuff. I'll throw it out to you, but don't feel like you have to kind of be focused on that this weekend. Just focus on studying for the M&A test. Remember, there's 2 parts. Q&A, know the different types of acquisitions, know the different transaction adjustments, know the process, the M&A process from a high level, and then just know how to do all these examples that we've been going through on the board, best exemplified by the quick analysis that I emailed you guys yesterday. Any questions, let me know. So Monday's the test. Tuesday, Wednesday, Thursday, we're going to start getting into more of these examples in the morning, and then the Heinz model as we go through. Any questions? Good. See you tomorrow.